Okay. So this student was asking two questions. When we were in the lecture, this Shipley value method, this was not covered and it will not be tested. Okay. Yeah, you want to know about the incremental cost allocation and the standalone cost allocation method. Yes, we do allow student who is asking me a question. So we do allow a cheat sheet for the final. So you are allowed to bring a full page. That will be 8.5 times 11. You are allowed to have notes on both sides. Okay. The second question is about the previous quizzes to practice. So, I will show you where to find those quizzes. Okay, let me see. So if you go to quiz, right, quizzes. So then you will see it's called a practice quizzes, right? So those practice quizzes, you can see I have all the 7 quizzes here. Right, so I have 1, 2, 3, 4, 5, 6, 7. Yeah. So these ones are the ones that you can practice for review purpose. You are not going to earn any marks, but you will be able to practice. Okay, so let me see. So no time limit. All times go 5. Okay, and so the expiry date is the end of August, so that should be enough. Okay, so that's where you find the quizzes if you need to review. So I think I answered all the questions to this student. This student was asking me lots of questions. So I don't have time to cover all of this, okay? I also need to cover some other students' questions. So the last 2, I will not be able to cover it in this lecture, but I'm going to cover the top 3, okay? And then I need to leave some time for other students. So, and then there are some other questions, general questions was asking about, is it possible to open Canvas quizzes? So yeah, that was open. And for the review purpose, the chapter 20 and 21 assignment, that was also created. So, so that should be okay. So now I'm going to talk about the first 3 questions the student was asking. So chapter 11, 13, 15, 14, 15, 16, 17. Yeah. So the question was asked for this 11 and 13, this question. So the question is about so the minimum price. So you learn about the transfer price. Okay, so the minimum price. So the question goes like, the flight fabrics makes pants from a special material. The fabric is special because the way it fits many body types. The pants sell for 136. A well-known retail establishment has asked the flight fabrics to produce 3,000 shorts from the same fabric. The company has unused capacity, so Brooklyn, the owner of the flight fabrics, calculate the cost of making a pair of shorts from the fabric. Cost for the pants and the shorts are as follows. So you can see we have materials, the fabric, cost, and we also have the direct manufacturing labor cost, and also variable overhead, fixed overhead allocated, and total cost. So the requirement one is, suppose this company can acquire all the fabrics that it needs. What is the minimum price the company should charge the shorts? So the idea here is what would be the minimum price a company should charge. So the minimum, I guess, that means that you are not losing money, right? So you may not making money, so you just break even, right? The revenue equals cost. So that will be the minimum price. So in this case, if I need to make a shorts, right? You need the materials, the $52 cost. You need to have this manufacturing labor cost, 11, variable overhead, 4, but this $8 fixed manufacturing overhead cost, this is allocated, right? That means even you don't manufacture the shorts, that fixed manufacturing cost will be still there, right? But it will be all allocated to the pants, right? So the idea here is that $8 fixed manufacturing cost is irrelevant, right? Doesn't matter whether you make the shorts or you do not make the shorts. So this cost is irrelevant. This cost is there anyways, right? So therefore, I will know that my cost, right, relevant to this decision making is 75 minus $8. So that will be 67. So that will be materials, labor, variable manufacturing overhead. So I add up this one, that's $67, right? So that's my cost. So therefore, if I charge 67, okay, so it's okay because I'm not losing any revenue. I'm not losing any contribution margin. But if I charge the below this price, and then you are losing the money, right? So that's the idea. The minimum price should be 67. Okay. If you understand this question, please give me a thumb up. 1, 2, 3. If you understand this question. Yeah, I guess some students are still finding the button for the thumb up, right? So let's do this again. Okay. If I know that most of you understand, I will not waste time on this question. Okay, let's do this again. Okay, if you understand this question, please give me a thumb up. 1, 2, 3. Okay, so for the other students, please ask me a question. So which part you find you don't understand? If you didn't give me a thumb up, you have to ask me a question. Yes, the recording will be posted. Yeah. Okay, some students couldn't find the thumb up button. That's fine. Okay, anyone have any question? Okay, so I will move on. So the second question is asking, now suppose the fabric is in short supply, right? So this is the topic touching the constrained resources, right? You have certainly limited amount of resources. Every yard of the fashion fabrics used to make shorts will reduce the pants that it can make and sell. What is the minimum price it should charge for the shorts, right? So this is the point, right? When you have insufficient capacity in this question, that is the materials, right? So if you use that materials for shorts, you are not able to use it for pants, right? So therefore, when you consider about how much price you charge on the shorts, you have to consider that opportunity cost you give up, right, for not making the pants, right? So we have learned the incremental cost is $67, including the materials, labor, and the variable overhead. That's the $67. But now we have to add additional opportunity cost. That opportunity cost is because the fact that we manufacture the shorts, we are not able to make the pants, therefore we are losing the contribution margin, right? So we want to figure out how much the contribution margin have been lost, and then we'll spread that loss over 3,000 shorts to figure out the opportunity cost per shorts, right? And we add that amount to $67. That's going to be the new minimum price. Okay, so here we know that what's the contribution margin for the pants, right? We want to consider what's the contribution margin for the pants. So the fixed manufacturing cost is irrelevant, right? Because it doesn't matter you make pants or you make shorts, that fixed manufacturing overhead is there, right? Doesn't matter what decision you make, you will not change that fixed manufacturing overhead. So therefore, in my calculation, so my contribution margin would be my selling price, 136 for the pants, minus materials 104, labor 22, and also variable manufacturing overhead 8. I get $2 of the contribution margin per pant. Right? Okay, so now we need to produce 3,000 shorts, right? How many materials we're gonna need? How many fabrics we're gonna need? So we learned from this table that each shorts is gonna require 4 yards of the fabric, right? Each shorts is gonna require 4 yards of the fabric. So I'm making 3,000 shorts times 4 yards each short. I'm going to need 12,000 yards, right? So in order to have this 12,000 yards available for the shorts, you have to cut down the production of the pants, right? Because you don't have that additional fabrics. For pants, each pants requires 8 yards, right? So this 12,000 yards would have been used to manufacturing 1,500 pants, right? So 12,000 yards divided by 8 yards per pant. So that's the 1,500 pants, right? So the idea here is 12,000 yards can either make 1,500 pants or 3,000 shorts, right? So you can't get both, right? So because you only have so much yards of the fabrics, so you either use it for making 3,000 shorts, okay, or you use it for making 1,500 pants, okay. So now the decision is to make 3,000 shorts. So that means I have to cut down the production on the pants by 1,500 units. So for each unit, the contribution margin is $2. Okay, for each pants, it's gonna help you to make $2. Then if you cut down 1,500 pants, you are losing $3,000 contribution margin, right? So that's the total contribution margin you lose because you decide to use the 12,000 yards for the shorts, not for the pants. Okay, so the total loss is 3,000. I want to know how much this cost has to be shared by all the shorts. There are 3,000 shorts. You lost $3,000. There are 3,000 shorts. So therefore, each short will take $1 loss. That's the opportunity cost, right? So your incremental cost to make these shorts is $67, right? And then the opportunity cost for making these shorts is $1. So you add that. So therefore, that minimum selling price now is $68 per short. Okay, so if you understand this answer to this question, please give me a thumb up. 1, 2, 3. Okay, thank you very much. If you don't understand this question, please ask me a question. Okay, I will move on. So now that we are at 14:15, the student asked me to go through this one, 15:20. This is a question I already touched during the class. So I'm not sure if the students maybe just missed the class. But I honor my promise, right? You ask me a question, I will answer your question. So the question is about you have different in a company. You have different departments. You have supporting departments, right? You have other operating departments, right? So the idea is, how do we allocate the cost of the supporting department appropriately to the operating department, right? So in this example, you have two supporting departments. One is the main, the other one is information system. So in short, we call it AS and the IS, right? And then you have two operating departments. One is the government consulting, the other one is corporate consulting, right? Okay, so now the question is, there are budgeted overhead costs. For the supporting department, $600,000 for AS, $1,200,000 for IS, right? So the idea is, how am I going to allocate these two cost numbers to the operating department, the government consulting versus the corporate consulting, right? So we have different methods to do that. So the first method is called direct method, okay? So for direct method, this is probably the easiest one. I'm going to ignore the mutual service between the two supporting department, okay? So I will treat it as if AS didn't do anything for IS didn't do anything for AS, okay? So that's basically how we do it, right? So now, in that case, okay, you can take a look at AS, right? The work supported by AS is 25, 40, 35. Add them up together, that's the 100%, right? So I'm going to ignore that 25% support to AS by support to IS by AS. So I'm just going to allocate this $600,000, the cost for the of the AS department to government and corporate consulting operating department. So how do I allocate it, right? So I'm going to allocate. Oh, sorry, this is not the direct method. Why? This is a direct method, right? So this is how the allocation works, right? So here, 40%, 75%, 35%. So together, this together is 75%. Okay, so the relative portion is 40 over 70 for government and 35 over 70 for corporation, right? So I'm gonna rely on this relative proportion and multiply it by $600,000 total cost. So I get basically 330,000 for government, 280,000 for corporate. So same idea. So this support by IIS is 10%, 30%, and 60%, but I will treat as if IIS didn't serve AIS. So now I consider just allocate the $2,400,000 cost of IIS to be shared by government consulting, corporate consulting. So 30%, 60% together is 90%. So I take that relative proportion, 30 over 90, 60 over 90. So I multiplied it by 2.4 million. So I get 800,000 for government and 1.6 million for corporation. So in this case, we ignore the mutual service within that supporting department, right? You have two supporting department, they serve each other, but we ignore that, okay? So does this make sense? So if this makes sense, please give me a sum up. 1, 2, 3. Okay, does anyone have any question? Okay, so I'm going to move on to the step down method, right? So step down method, in this case, you have to pick an order, right? So we are saying which cost you are going to allocate first, okay? In this example, I'm going to show you when we pick AS, the main service department, as the first, okay? That means I will first allocate the cost of AS. The cost of AS is $600,000, okay? And then the allocation goes, the red color number, 25 for IS, 40 for government, and corporate is 35. So therefore, based on this percentage multiplied by the total 600,000, okay, so I'm going to get assignment of 150,000 to the IIS, and okay, so why is coming back? And the 240,000 for government consulting and 210,000 for corporate consulting. So this is the first step. Second step, now the IIS cost has increased because there is allocated cost to IIS from AIS. So now my new IIS cost is 2,400,000 plus 150,000. So my new IIS cost is 2.55 million. And I'm going to allocate this cost only to the government consulting and corporate consulting based on the relative proportion of the two departments. Okay, so does this make sense? So give me a sum up. 1, 2, 3, sum up. Okay. Any questions for the step down? Okay, I'll move on. The third method is called reciprocal. right? Reciprocal. In this case, they would consider that mutual interaction between the two service supporting department. So in this case, I have to use a little bit of algebra, okay? So I want to know what is the cost for AS, what is the cost for IS, okay? So I would assume the cost for AS is just AS, the cost for IS is just IS. We know that IS, 10% of IS cost, okay, is for the AS. We know 25% of the cost of AS is allocated to IS, right? Okay, so this is how I got it, right? So I have AS equals $600,000 plus 10% of IS. And now take a look at IS. IS is this $2.4 million. Okay, this is the cost before any inter-department cost allocation, right? So you haven't considered that inter-department cost allocation. This is just the cost. Plus, so that's 20%. 20% of AS, right? So AS equals 600,000 plus 10% of IS, and then IS equals 2.4 million plus 25% of AS. So you can see there are two equations and there are two unknowns. So therefore, you are able to solve this equation, okay? Once you solve the equation, you know what's the AS, right? And what's the IS, then you are able to use that to figure it out, right? This allocation to the government consulting versus corporate consulting. Okay, does this make sense? If this makes sense, please give me a thumb up. 1, 2, 3, thumb up. Mm-hmm. Any question? Okay, I will move on. I think this student was asking me to 16, 17. There are 3 questions. Okay. So this question is also covered at school during the class. So basically, this is about joint product by product, right? We need to think about the cost allocation. So in this case, each chicken is disassembled into 5 main parts: breast, wings, thighs, bones, feathers. Okay. Then you can think about this is the production information in July. So it tells us the weight in terms of kilograms for each parts, each of the 5 parts. The whole wholesale selling price per kilogram when production is complete, right? So you have a production. At the end of the production, you have these 5 parts, right? And then at that time, the price for each part that can be sold. So in July, the joint cost of the production is $60, right? there is a special shipment of 60 kilogram of breasts and 20 kilograms of wings has been destroyed in a fire. They have an insurance policy. They want to ask for reimbursement for this loss. And the insurance company will say, well, you have to calculate how much does that cost you, right? So I'm going to reimburse you, but I want to know what is that cost? What is that number? So the question here is the company permit this corporation to use a joint cost allocation method. The split off point is assumed to be at the end of the production process. Required, number one, compute the cost of special shipment destroyed using sales value at the split off point, split off method, physical measure method, kilograms of finished product. Number two, which cost joint cost allocation method would you recommend? Okay. Okay, so this is what happened, right? So we were given the information, the column 1, 2, right? We know what's the weight for each part at the end of the production. This is the July information. What's the weight for each part, right? And then we also, okay, this is B, sorry, we have to do A, yeah. So this is the weights, right? And then in terms of the weighting, hey, how come I'm not, yeah, this is the one. Why is keep going back to B? I don't know. Okay, so, and then I know the wholesale selling price per kilogram. So this information of these two columns is given, right? This is the given from the question. So you know the weights for each part, and you also know the selling price per kilogram, per weight. So this, I'm gonna use multiplication. This will tell me the sales value at the split off point, right? So I'm just calculating this column by multiplying these two columns. If I add the 5 parts together, this is going to be my total sales revenue. I know the revenue from each part. I know the total revenue. Therefore, I can calculate it. My percentage based on the sales value. Okay, based on the sales value. Therefore, the total joint cost is $60. I'm gonna multiply $60 to all these weights to get the cost allocated to each part. Okay, so the joint cost allocated, this is the total joint cost, and then you're gonna divide it by your weight to figure out how much allocated joint cost per kilogram. Okay, so with that information, I would know, okay, so each kilograms of chicken breast, that allocated joint cost is actually close to 40 cents, right? So I have 60 kilograms. So the cost for the chicken breast would be close to $24. And for the wings, the fire destroyed 20 kilograms, and the joint cost is almost, it's just more than 15 cents per kilogram. So I get $3.06. Okay, so these are my two costs for that breast and the wings destroyed in the fire. When I'm the item up is $27. So basically this calculation will show us that the amount of the total joint cost allocated to those items being destroyed is $27, for which the company would pursue a reimbursement, right? So this is the method we are using by the sales value at split off point. So basically, we are using this information, right, to calculate the percentage, right? Eventually, you use $60, that is your joint cost, multiplied by a percentage, right? So the different method will get you a different percentage, right? So this is the first question, is to use the sales value at split off method. So we just calculate what's the sales revenue at the split off point, and then we calculate the percentage. Right? Okay, so if you understand this question, please give me a thumb up. 1, 2, 3. Okay, thank you. Do you have a question? Okay, so I will move on. So the second question is that you do the same problem, but this time, instead of using sales value at split off point method, you are using physical measure method, right? So in this question, what is the physical measure? The physical measure is the weight, right? So you can, in July, you know the weight for each part, and then just add add them the weight of the 5 parts together to get the total weight. And you're going to use this as a way to calculate your percentage. So I'm going to rely on the weight to calculate the percentage. And I'm going to use the $60 times this percentage to get the amount of cost allocated to each part. And then I'm going to calculate this joint cost per kilogram. Okay, the joint cost per kilogram. Okay, and so in this case, it's interesting because they're all the same, right? So the allocated cost per kilogram is the same. And so how does that work? It's because the cost allocation is based on weight, right? If it's heavier, they were assigned with more joint cost. If it's lighter, they were assigned with less joint cost. But the cost per kilograms is the same, okay? Because the allocated cost based on weight, therefore the allocated cost per kilogram is the same, 0.245. So then I want to calculate what's the cost of the destroyed product. So the total weight is 80, and times 0.2545, I get $19.60. So if you understand this question, please give me a thumb up. 1, 2, 3. Okay, thank you. Does any of you have a question? So if you use 0.245, so that's the cost per kilogram multiplied by the total weight, right? The total weight is 245. You get $60.02, right? So that's That's consistent with the $60 here, right? Okay, so which method would you recommend, right? So basically, if you think about a very important concept used by the financial accounting courses is about matching principles, right? So you need to match expenses against the revenue, right? So you have to think about these expenses is the reason for earning the revenue, therefore you have to match them, right? So this is a similar idea. So you are thinking about that joint cost allocation, right? So instead of going with physical measures, you should think about that certain parts, they will generate more revenue, right? Therefore, they should bear more cost, right? It's kind of like in this country, right? You think about the rich people, right? Or the people who are in the middle class, right? They make a lot of money every year. Well, they pay more tax, right? So that's the idea is that it's fair, right? If you make more revenue, you take more cost of the society, right? So if this society rewards you with more revenue, you need to bear more cost. So that's kind of the concept, which reflected in the tax systems in Canada, right? So in this case, we are saying for the sales value split off method is more appropriate because this method reflects this fundamental idea, right? So if you take a look at here, right? If you take a look at here, the breast, right? The breast is almost 70% of the total revenue, right? So the part of breast, their revenue is 70% of the total revenue. So therefore, it makes sense they take 70% of the cost, right? The feather, right? Look at this feather. This feather is valueless, right? It's worthless. The feather is only like the weight is 0.3% of revenue, right? So the feather's revenue contributes only 0.3 of the total revenue. So therefore, they should bear less cost, right? They should bear less cost. They should bear 0.3% of the cost. But if you take a look at based on weights, right? Okay, if you based on weights, because of these heavy parts, right? The bones, these are the heavy components, right? So the proportion of the breast now is only 43%. Okay, so if you think about the value from the previous slide, right? The breast revenue percentage is 70%, right? But if you go by weight, it's 43%, right? So based on the idea of, the revenue matches the cost, it's much better to use the split off method, right? So you should not penalize people because of their weight. You should not penalize the bones by assigning them more cost because they're heavier, right? I think I will lose more money if they assign cost based on the weight. Okay, so I guess I'm not sure if you think that's funny. I can't see any reaction. Okay, so you know the point here. So basically, we would recommend to go with that split off point, right? Split off sales method, right? So does this make sense? If this makes sense, give me a thumb up, please. 1, 2, 3. Okay, awesome. Okay, it's funny this time. I can't do this quick enough. I should take a screenshot. The sum, the way how it lined up on my layout, looks like a triangle. It's just like an arrow triangle. The sum up. That's really interesting. So the next question is same. It's related to. I think it's related to 16-16. So this is still the same question, okay? So you have this company computing the ending inventory value for its July 1st statement of financial position. So the ending inventory amount on July 31st are 20 kilograms of breast, 5 kilo of wing, 10 kilo of thighs, 10 kilo of bones, 5 kilo of feathers. The company management wants to use sales value and split off method. However, they want you to explore the effect on ending inventory value of classifying one or more products as a byproduct rather than a joint product. Okay. So in the last question, we do all these calculations based on the assumption that all the 5 parts, they are joint products, right? That means they are equally valuable, right? But probably that's not the case. So in this question, they take a step further. So just to break that assumption. So not all these 5 parts are equally valuable. Some parts are not that valuable. Therefore, we call it a byproduct, right? Low value, we call it byproduct. So the first question is, they want you to use the first assumption. So all 5 products are joint products. Treat them as if they're all valuable, and then calculate the ending inventory. So we did this already, right? We were told the number of the kilograms in the ending inventory for each component, each product, and we already calculated the joint cost per kilograms for each product under sales value split off method. So these numbers all been calculated before. If you don't believe me, I will show you. It's right here, right? So these numbers. Okay, and then I add them up. This is my total ending inventory. And now the second question, assume they use production method of counting for byproduct. Okay, then we assume the breast and the thighs are the joint product. The wings, the bones, and the feathers are byproduct. So the idea here is that the byproduct, they are low value, okay? And they are not the reason why you have this process, right? So the idea in this assumption is that you are processing this for the breast and the thighs, right? Those are the joint product. And the byproduct is not what you want, but you can still sell them to recover some of the cost, right? So what is the calculation, right? The calculation is going like, how much I can sell for the wings, bones, and the feathers, right? Those are the byproduct. So let's take a look. So the cost, the sales price, right? Let me take a look at the sales price. So here, this is my selling price. For wing is 25 cents. Bones is 10 cents. Feather is 5 cents. Okay. And then I need to know how much I can sell these byproducts for, right? So you can see I can sell these wings, right? I can sell these wings 6.25. I can sell all the bones to get $7, sell all the feathers to get 25 cents, right? So wings for 6.25, bones for 7, feather for 25 cents. So if I sell all the wings, the bones, and the feathers, I can get back $13.50, right? So this is the byproduct, right? So the idea here is when I have this byproduct, I would just treat it this revenue from the byproduct as a way to recover some of my cost. So what's my total cost? My total cost is $60, right? And by selling this byproduct, I'm able to get $13.50. So this is the cost recovery. So therefore, you can just treat it as if your joint cost for the breast and the thighs is actually just $46.50. So now you're gonna do the same calculation, but this time just using the two joint products, right? So you calculate their revenue, right? So if you sell all the breast, all the thighs, what is the revenue? And then you calculate what's the relative proportion among the two product. Okay, and then you would allocate this time not $60, right? You would allocate the $46.50. And then you realize that for breast is the amount of cost assigned is 37.67 divided by 105. So it's 0.3588 cost per kilogram. Okay. And for thighs, that's the 0.2208 per kilogram. I know on the ending inventory now, I have breast 20, thighs 10. So then I calculated my ending inventory is $9.38. So does this make sense? If this makes sense, please give me a thumb up. 1, 2, 3. Does anyone have any question? Okay, so I will move on. So this is the comment when we treat them differently. So treating all products as joint products does not require judgment as whether the product is a joint product or a byproduct. Joint costs are allocated in consistent manners to all products for the purpose of costing and inventory valuation. In contrast, the approach in second requirement lowers the joint cost by the amount of byproduct net realizable value, result in inventory values being shown for only 2 of the 5 products. Okay, and the ones designated as being joint product. So that's what we did, right? So you consider that all those low valuable byproduct has been sold, and that will reduce your cost, and your inventory only show that byproduct. Sorry, only show that joint product. This is the question revenue allocation. I think I provided the answer. is actually quite straightforward and simple. So when you think about the standalone method for bag M plus RCC, so basically you want to know how much of each of these items can be sold on its own, and then you add them up, and then you calculate that percentage, and then you know how much money you get when selling two components together. That's the $90. And then you're going to allocate that $90 based on the relative percentage, right? So that's the standalone method. Incremental method, depending on which go first, right? So, for example, if you go bag M first, when you are allocating the revenue, so this first item will get the full revenue, the same amount of revenue as the product is sold by itself, right? And then RCC is the residual, right? So that's the 90 minus 60, that's the residual. And of course, you can pick RCC first, right? So the full standalone price for RCC is 40, and the remaining left for bag M is 50. Okay, let me take a look. So does this make sense? 1, 2, 3. Give me a thumb up. 1, 2, 3. Okay. Does anyone have any question? Okay. This second question is exactly the same approach. The only difference is now it's a two different product. Instead of bag M, it's the con M RCC, right? So that package is different. But that calculation, the idea behind it is exactly the same. Okay. So now I'm gonna take a quick break. Okay, 5 minutes break. What time is it? We're gonna take a 5 minutes break. So come back at 11:05. Okay, and then if you have any questions, maybe put it down and let me know. Okay. So let's take a 5 minutes quick break. Okay. Okay, I hope you all come back. So let me know if you are back. Give me a thumb up if you're back. Okay, we'll continue. Okay, so this student was asking me to go through some questions here. So I will do the first two. So this is a question. It's about the variances, sales, quantity variance, mix variance, volume variance. Okay. So Guangzhou Corporation sells two brands of wine glasses, plain and chic. GC provides the following information for sales in the month of June. So you have a static budget, total contribution, 5,600. Budgeted units to be sold of all glasses, 2,000 units. Budgeted contribution margin per unit of plain, $2 per unit. Budgeted contribution margin per unit of chic, $6 per unit. Total sales quantity variance, 1,400. Okay, unfavorable. Actual sales mix percentage of plain, 60%. Okay, all variances are to be computed in the contribution margin terms. So require to calculate sales quantity variance for each product for June. Calculate individual product and total sales mix variance for June. Calculate individual product and total sales volume variance for June. And briefly describe the conclusions you can draw from the variances. Okay. So in order to calculate all these sales volume variance, sales mix variance, and sales quantity variance, so you need to know a bunch of things, right? You need to know the actual production, right? You need to know the actual mix. And you need to know the budget production and the budget mix, right? So once you know all those information, you have the formula, right, from the textbook. So you should be able to do all the calculations just by following the formula, right? And I trust that in the exam, you are going to probably write down the formulas for these different variances, right? So in this question, we were not given the information, okay? We know the actual mix. So actual mix is 60 for plain, 40 for check, but we don't know the budget mix. We know the budget units to be sold, 2,000 units. We don't know the actual units to be actually production units sold, right? So we had to figure out first our budget sales mix percentage, second the actual sales, right? Actual sales. So this is a situation that you have to work backward, okay? So what we can do here is that if you think, take a look at this, right? The static budget contribution is 5,600, and the budgeted units of all glasses to be sold is 2,000, right? So right away, I'm thinking that right away, so my total cost contribution margin would be 5,600. My total number of units, so this all these classes, including plain and check, right, is 2,000. So 5,600 divided by 2,000. So what do I get? I get $2.80 per unit. Okay. So which is makes sense, right? Because if let's say you sell all the units as plain, right, that contribution margin per unit is $2, right? So $2. If this is all, if you sell all planes, right? If you sell all check 100%, if 100% of the sales is check, it's $6 per unit. If 100% of sales is plain, it's $2, right? But this is sales mixed. It has to be a number between these two numbers, right? $2 and $6. And we just calculated. This is here, 2.8. So now you can tell me, in that sales mix, which product will have more weight? Just take a look at this picture. Here is 2, here is 6, and the average is 2.6, 2.8. So based on this, just guess which product would have more weight in that sales mix. Okay, let's see if you are very smart on this. Okay, so the average is 2.8. It's between 2 and 6. So where do you think the weight is on? It's on plain or on, more of the weight will be on plain or it's on check? Plain, that's good, right? Because this average is leaning towards to 2, right? So if it's $2, that means 100% of the sales is plain. If it's $6, that means 100% of sales is check. And now it's 2.8, it's closer to 2. That means that percentage must be, like the plain must have a higher percentage, right? So how do I do that? So I would assume, the percentage is Y, okay, for plain. And then for this check, the percentage will be 1 minus Y, right? So I will do 2 times Y plus 6 times 1 minus Y. That will equals to 2.8. So now you solve Y, you realize Y equals 0.8. So that means 80%. This is my budget, right? This 80% in my budget is the plain, right? 20% of that mix is check. So this is on my budget, right? Because this is my budget margin, budget units. So that this is my budget weighted cost. So this is my budget sales mix, okay? So let me see. Does this make sense? So if it makes sense, give me a thumb up. 1, 2, 3, thumb up. Anyone have any question? Okay, so we done on the first step. We are able to calculate the budgeted sales mix. Okay. So now let's figure out what's the actual units sold. Okay, so this is from one of our slides on the PowerPoint. So sales quantity contribution variance, right? Sales quantity contribution variance is the difference between budgeted contribution margin of the actual units sold and the contribution margin of the budgeted units sold, right? So budgeted contribution margin of actual units sold versus contribution margin of the budgeted units sold. So both at the budgeted sales mix, right? Budgeted sales mix. So I assume the total actual units sold is Q, okay? So that's the total Q sold. I use my budget sales mix. So this tells me the number of units for plane, and it times 2. And this is my number of units of the chick times 6. So together, this is going to be my actual budgeted contribution margin, budgeted contribution margin of actual units sold. Right? So why is 4,200? Right? Why is 4,200? So here, okay, this variance, sales quantity variance equals budgeted contribution margin of actual units sold minus contribution margin of budget units sold, right? Budget unit sold. So what is my sales quantity variance? So it's unfavorable, 1,400. So this one is negative 1,400. Okay. And then this one is what we want to figure it out, minus what's the contribution of budget units sold. So the contribution of budget units sold is this number, 5,600. So therefore, my question mark equals $4,200. Okay, so this equals $4,200, and I solve Q is 1,500 units. Okay, so the total quantity of all glass sold is 1,500 units. So now with this information, you are able to calculate all of this, right? On the PowerPoints, you have the formula, right? So right now we know the actual sales mix, actual production, actual units sold, budget mixed sales mix, and the budget units sold. With those informations, based on the formula, you'll be able to calculate all of this. Okay. Okay, so does anyone have any question on this? Please first give me a thumb up if you understand this. 1, 2, 3. Give me a thumb up. Okay, thank you. If you don't understand, please ask me question. Okay, so let's move on to the next question. So what's the comment, right? Okay, so here they're saying the sales quantity variance is unfavorable because it sold fewer wine glasses, right? So we calculated the actual units is 1,500 units, but the budget units is total units is 2,000 units, right? So therefore, it's unfavorable in terms of the sales quantity because 15,000 versus 2,000, right? This unfavorable sales quantity variance is partially offset by a favorable sales mix variance. Okay, so so basically the budget sales mix is 80 for plain, 20 for cake, right? So you can see for plain is 80, for cake is 20, right? But the actual, this is a budget sales mix, but the actual is 60-40, right? So this is a good news because plain has only $2 contribution margin, cake has $6, right? So if you have more weight to cake, that's better, right? So in this, the actual number actually shifted this way, right? Because it's not 80-20, it's the actual number is 60-40. So you have more sales mixed for the item with higher contribution margin. So therefore, that sales mix variance is a positive. Okay. So offset by a favorable sales mix variance because the actual mix of wine glasses sold has shifted in favor of the higher contribution margin cake wine glasses. Okay, the problem illustrates how failure to achieve the budgeted market penetration can have negative effect on operating income. Okay, so our last question is this equivalent units, right? This is the process costing. We needed to allocate, we need to figure out how to calculate the cost of goods sold, cost of goods manufactured, and the ending work in process inventory, right? So what is the question here? So the question is using the weighted average method. So Mike Knight Handcraft is a manufacturer of picture frames for large retailers. Every picture frame passes through two departments, the assembly department and the finishing department. This problem focuses on the assembly department. The process costing system at Magnite has a single direct cost category, direct materials, and a single indirect cost category, conversion cost. Direct materials are added when the assembly department process is 10% complete. So as long as you are, just 10% complete, the materials will be added. Conversion costs are added evenly during that assembly department process. Mike Knight uses the weighted average method of process costing. Consider the following data for the assembly department in April. So work in process, beginning, started, completed, work in process, ending, total cost. And then we learn about the completion rate, right? So the physical units, in the beginning, you have 60 unfinished. You start during April 510. So in total, you have 570. You completed 450. Therefore, you have 120 left at the ending in work in process inventory. Beginning work in process is 100% direct materials completed. Conversion cost is 40%. And that cost corresponding to direct materials and their direct conversion cost. And then the ending work in process, direct materials is 100% complete. Conversion cost is only 15%. Okay, and then summarize the total department cost for April. Assign them to units completed and transferred out to the units in the ending working process. What issues should a manager focus on while reviewing the equipment unit calculation? So first, we're gonna do that. Let's see here. So first step, we want to check on the physical units, right? So the beginning 60 unfinished, and you start 510. So in total, you have 570 units to work on, and you completed the transfer out 450. So in the ending, you have 120. Okay, so that's the physical units. Okay, so what about the equivalent units, right? Equivalent units has two pools. So for direct materials, I'm dealing with 450. This is completed and transferred out. So those materials is 100% used, completed. So therefore, my equivalent unit is also 550. So 450 times 100% is 450. For the work in process ending inventory, so there's 120 unfinished units, but the materials has been 100% added. So 120 times 100%. So for direct materials, the equivalent cost is 570. For conversion cost, for those who completed and transfer out, that's 100% complete. So it's 450. Then for the ending, it's only 15%. So 15% times 120, so that's your 18 here. So together, the equivalent unit is 468 for conversion cost. Okay, so now let's calculate the total cost, right? So I have beginning materials, beginning conversion, and I also have the April cost. So together, I have the total cost for materials and total for conversion. And then I know my equivalent units is for materials is 570, for conversion is 468. So therefore, I'm able to calculate. So the cost per equivalent units is $34 for the materials and $25 for the conversion cost. So therefore, I need to calculate how many is what's the cost for those who completed and transferred out. So this is the 550 units, right? These ones are completed and transferred out, and I know their cost. Materials cost is 34, conversion cost is 25. So I'm able to calculate the total cost for the materials, for the items completed and transferred out is this. For the ending 120 units, again, I use equivalent cost, right? Equivalent units, 120, 18, and times the corresponding cost per equivalent unit. And you can see that at the end of the day, right, I allocated, after I done the allocation, my total cost allocated should equal to this total cost, right? This two should equal. Because that's how we allocated this total cost, right? So you have those ones transferred out, completely transferred out, those ones left in the ending inventory. Okay, does this make sense? If this makes sense, please give me a thumb up. 1, 2, 3. Thumb up, please. Does anyone have a question? No question? Okay, so let's take a look. So this is the way how our observation. If the supervisor wants to show a better performance, okay, so this is a trick you can do, right? So this cost, right? This cost here, this is in the inventory, right? It's on the balance sheet. So this number does not go to the income statement, right? This is a balance sheet item. This cost completed and transfer out, this cost might ended up in the income statement, right? Because some of the unit will be sold and they will take the form of cost goods sold in the income statement, right? So how can I overstating my operating income, right? So the way how I overstating my operating income as a manager, I want my income look better. So I want to make my income number to be bigger, right? So I have to cut my cost, right? So how can I cut my cost goods sold? Well, cost goods sold equals cost per unit times the number of units sold, right? So the number of units sold cannot be changed. But if I'm able to lower the cost per unit, therefore I will lower my total cost goods sold and increase my income. How can I lower my cost per unit? Okay, so how can you do that? So basically, this is how you do it, right? So here, see, when you calculate the cost per equivalent unit, you are calculating your cost per equivalent unit, right? You use your total cost, these numbers won't change, divided by their equivalent units, right? Equivalent units. So how can I lower this number? So if I want to lower the cost per equivalent units, I have to increase my equivalent units, right? I have to increase my equivalent units. How can I increase my equivalent units? Okay, I will say, guess what? The completion rate is higher, right? So if my completion rate is higher, my equivalent units will be higher, right? So that's the whole point. So basically, the supervisor might report a higher degree of completion, right? Therefore, they will have more equivalent units. Therefore, the cost per equivalent units will be lowered, and the cost goods sold will be lowered. Operating income will be higher, right? You can see this is one way the supervisor may manipulate their income. If the performance is good this year, okay, the supervisor may do something called income smoothing, right? If this year the performance is good, but next year it may not be so good, if the manager can meet the target anyways, right? Let's say the target is 1 million, the manager will make a bonus. And this year is 2 million, right? So it doesn't matter it's 1 million or 2 million, the manager will only make a fixed amount of bonus. So at this time, the manager will think, how can I bring down my income so I can save it for next year, right? So next year I have a higher chance to also meet the target. So in this case, to reduce operating income, they will do the opposite. They will report a lower degree of completion. Therefore, they would have reducing the number of equivalent units. Their cost per unit will be higher, cost of goods sold will be higher, income will be reduced, right? So therefore, you can see the estimation on the degree of completion can help managers to manipulate earnings from one period to the next, right? So in order to deal with this bias, managers should ask supervisors questions. How did you make the estimation? Is there any bias, right? You have to be able to make assessment, right? So it's interesting how these calculations can help us to understand, right, the things people can do, right, that only help themselves, not helping the organization, corporation. So does this make sense? If this makes sense, please give me a thumb up. So 1, 2, 3, thumb up. Okay, awesome. Does anyone have any question?